EPK Capital presents Daily Brief, 6 September 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host, Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. The jobs report. Jolt, a market in paradox. The central narrative of the trading day can be distilled to a powerful macroeconomic event, the August jobs report. The release of this data point created a classic bad news is good news scenario, leading to a profound tug-of-war on Wall Street. The day began with an early rally as a continuation of the positive momentum from the previous session. However, upon the jobs report's release, that momentum was erased. The S&P 500, which had printed a new all-time high just the day before, reversed course, erasing its early gains and sliding into negative territory. This fluctuation was a direct reflection of the market's internal debate. Was the economy slowing so much that a recession was imminent? Or was this simply the long-awaited signal for the Federal Reserve to finally begin cutting interest rates? Ultimately, the market's modest declines suggest that the conviction for a Federal Reserve rate cut outweighed the initial fears of an economic downturn. The stock market's muted reaction, in which more stocks rose than fell despite the major index drops, illustrates this delicate balance. The day's trading action showed that investors were positioning themselves not for a collapse, but for a new monetary policy cycle. A closer look at the key U.S. indices reveals the extent of this wobbly performance. The S&P 500 fell by 20.58 points, a 0.3% decline from the all-time high set the day before, closing the session at 6,481.50. The Dow Jones Industrial Average saw a more significant drop, shedding 220.43 points, or 0.5%, to finish at 45,486. The technology-heavy NASDAQ composite was nearly flat, dropping only 7.31 points, a decline of less than 0.1%, to close at 21,700.39. Amid the general retreat, one index stood out, the Russell 2000. The index of smaller companies bucked the trend, rising by 11.43 points, or 0.5%, to a closing level of 2,391.05. This move suggests that some investors were making a direct bet on the domestic economy, anticipating that smaller, domestically focused companies would be a primary beneficiary of a coming rate cut. While the daily performance was negative for the main U.S. indices, a broader perspective reveals a more nuanced picture. Over the course of the week, both the NASDAQ and the Russell 2000 registered gains, climbing 1.1% and 1.0% respectively. The S&P 500 was also up for the week by 0.3%. For the year, the performance remains robust, with the S&P 500 up 10.2% and the NASDAQ leading the way with a 12.4% gain. Deconstructing the macro shockwave. The reason for the market's behavior can be found in the core data of the August jobs report. The headline number was weak, but the true significance lay in the revisions to past months. August payrolls saw an increase of only 22,000 jobs, a number that came in well below the already modest forecasts of 75,000 to 120,000. The unemployment rate ticked up to 4.3% from 4.2% in July, a gradual upward trend that has been in place since June. However, the real shock to the system was the dramatic downward revision to previous data. The Bureau of Labor Statistics revised the initial report for June from a gain of 139,000 jobs to a loss of 13,000. This marks the first time the labor market has contracted since December 2020. The revisions for May, June, and July were a staggering combined loss of 279,000 jobs. This is a critical distinction. A single month of disappointing data could be an anomaly, but the conversion of a reported gain into a loss indicates a persistent and accelerating weakness in the labor market. This changes the narrative from one of a slowing market to one that is actively contracting. This deeper trend provides a far more powerful catalyst for a Federal Reserve response than a one-off weak number ever could. The data's implications for the Federal Reserve's policy are significant. The Fed operates under a dual mandate to promote both maximum employment and stable prices. With the evidence of a rapidly weakening labor market, the maximum employment side of this mandate is now squarely in focus. Federal Reserve officials, including Chairman Jerome Powell, have already signaled that a rate cut is a strong possibility at the upcoming September 16th and 17th FOMC meeting. The August jobs report has reinforced this case, and in the view of many analysts, it has cemented the expectation of a rate cut. Chairman Powell has previously acknowledged that while the labor market started the year with strong growth, the momentum had been whipsawed by uncertainty, and that the downside risks to employment are rising. Today's report indicates those risks have now materialized, providing the Fed with the necessary justification to shift its policy stance. Political forces and their financial fallout. The release of the jobs report was not just an economic event, it was a political flashpoint. President Donald Trump has a history of publicly pressuring Fed Chair Jerome Powell for rate cuts, and his immediate comments following the report's release were consistent with this pattern. The president told reporters that the Fed chairman was too late and should have lowered rates a long time ago. These remarks come on the heels of the president's prior firing of Bureau of Labor Statistics Commissioner Erica McIntarfer, a move that added a layer of political tension and controversy to the release of official economic data. The politicization of economic data creates a unique challenge for investors. The weak jobs report provides a clear signal to cut rates to support employment, which should be a straightforward policy response. However, the Fed must also contend with the inflationary pressures created by the president's tariff policies. Fed officials, including Powell, have expressed concern that these tariffs are generating a rise in inflation. This creates a challenging scenario for the Fed, where its dual mandates are in tension. A rate cut to stimulate a weakening labor market could potentially exacerbate the inflation caused by the tariffs. Conversely, holding rates to fight inflation could lead to a deeper downturn in employment. The Fed is caught in a high-stakes dilemma, and its actions must now be weighed not just against economic data, but also against a complex and often conflicting political landscape. The effects of these US-centric events rippled across the globe. Indian equities, for example, experienced a volatile trading session that ended with both the BSE Sensex and NSE Nifty closing nearly flat. This was the result of a push and pull between positive domestic cues, such as New Goods and Services Tax, GST, structure changes aimed at boosting consumption, and weakness in key sectors like IT and FMCG. Meanwhile, European markets, which had started the day with gains, surrendered them to turn lower in tandem with Wall Street, demonstrating the global contagion effect of the US jobs data. The digital frontier, a market in flux. In stark contrast to the wobbly performance of traditional equities, the cryptocurrency market celebrated a significant milestone. Its overall market capitalization reached a new record of $4.11 trillion. This accomplishment highlights a fundamental shift in the crypto narrative, moving it from a purely speculative asset class to a strategic component of corporate finance. Bitcoin, the market leader, ended the day on a high note, gaining 1.65% to close at $111,624.06. This was the sixth time in 7 days the asset had seen an increase. While Bitcoin's performance was notable, a deeper analysis of capital flows reveals a critical trend. Analysts point to a sharp divergence in institutional behavior throughout August, with Ethereum spot ETFs amassing approximately $4 billion in total inflows, while Bitcoin ETFs saw about $2 billion in redemptions. This indicates a sustained rotation of institutional capital toward Ethereum, driven by its staking yield and the promise of decentralized finance, DeFi. The most critical, yet underreported catalysts for this institutional adoption are regulatory and accounting changes. The US Genius Act and Europe's MyCar framework are cited as key regulatory breakthroughs that have provided legal clarity for digital asset custody and trading. A particularly significant development was the rescission of SEC Staff Accounting Bulletin 121, SAB 121. Under SAB 121, financial institutions were required to treat their clients' crypto assets as a full liability on their balance sheets, a rule that made crypto custody prohibitively expensive and largely unfeasible for traditional financial firms. The new rule, SAB 122, changes this, allowing financial institutions to account only for the risk of loss of such assets, which is a much smaller amount determined by their own risk models. This change effectively removed a major obstacle for institutional participation, opening the floodgates for traditional finance to engage with the crypto space. Beyond the institutional flows, the underlying technology continues to mature. The Ethereum Foundation, for example, has rolled out Protocol Update 003, Improve UX, which aims to enhance user experience by improving interoperability, reducing latency, and lowering costs. In a similar move, the Tron community voted to slash network transaction fees by 60% to drive long-term adoption, particularly for stablecoin transfers. Another major trend gaining momentum is the tokenization of real-world assets, RWAs, which connects blockchain to traditional markets. Evidence of this includes BlackRock's Buidl Fund, which tokenizes U.S. Treasuries, and HSBC's tokenized gold trading platform. Conclusion and what to watch next. The events of September 5th, 2025 presented a powerful and complex narrative. The day's central paradox, that a weak labor market could be a positive signal for investors, is a testament to the dominance of monetary policy expectations in today's financial landscape. The significant downward revisions to the jobs report provided the Federal Reserve with a clear directive to prioritize the employment side of its dual mandate, likely cementing a rate cut at the upcoming FOMC meeting. Simultaneously, the political commentary surrounding the report and the ongoing economic impact of tariffs highlight the increasing complexity and politicization of economic data, a factor that investors must now contend with. This divergence in policy levers creates a challenging environment for the Fed, which must now navigate the competing risks of a weak labor market and tariff-driven inflation. Meanwhile, a parallel story is unfolding on the digital frontier. The cryptocurrency market, fueled by new regulatory clarity and strategic institutional adoption, is proving its resilience and maturity. The record-breaking market capitalization, the rotation of capital into Ethereum, and the strategic move by companies to hold digital assets as treasury reserves are powerful signals that this market is on a trajectory toward mainstream integration. Looking forward, the financial world will be closely monitoring the next actions of the Federal Reserve at its meeting on September 16th, 17. Any further comments from political leaders and new economic data releases will also be scrutinized for their potential to shape the Fed's decision. The continuing evolution of the crypto landscape, especially the institutional capital flows and the progress of RWA tokenization, will also be key themes to watch as the digital asset market continues its transformation. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.